Nick Sly, Denver branch executive with the Federal Reserve Bank of Kansas City. Great to have you back on the Business Brief.
Ryan, thanks for having me back.
Nick, new year, perhaps new prospects and opportunities. What's your 2022 outlook for Colorado and the Rocky Mountain region's economy?
Looking ahead, Ryan, I'm looking more to see that type of growth that's in line with the longer run trends, the typical type of growth that we had seen prior to the pandemic throughout the region. And that's really different from the accelerated pace of growth that we had last year that was important for filling the gap that came from this pandemic-induced downturn. So as opposed to that rapid recovery and that faster than average pace of growth that we had as we were starting to get things, the economies reopened, we were starting to get folks moving about. I think we would see growth that's more in line with some of the longer run trends that we had for the region, that typical type of growth that we had prior to the pandemic.
There's also lingering issues like the pandemic's next turn, as well as labor market tightness. We learned recently that 4.5 million Americans quit their jobs back in November of last year, the most in decades. As such, job openings are holding near record levels, with vacancies reported at 10.5 million in November, according to the U.S. Department of Labor. How do you see labor market tightness playing out?
Well, first of all, I think we certainly see labor markets as being tight, even though that unemployment rates and some measures of joblessness are still a little bit above where we were prior to the pandemic. I do agree that there's a lot of indications that labor markets are tight. And that has brought with it a number of outcomes and features for households that are important to recognize. So, for example, I think we're seeing wage growth as businesses are having to add wages, add compensation to be able to attract and retain workers. We're also seeing things like fewer people have part-time jobs because of economic reasons, part-time jobs because they couldn't find full-time jobs. And we're seeing fewer and fewer individuals, particularly throughout this region, that have what we call multiple job holders, that have to have multiple jobs just to be able to make ends meet. And then, as you alluded to, Ryan, there's also a number of people who are leaving their jobs either for retirements or leaving their jobs to seek better compensation elsewhere. And that tightness, those features of wage growth and the confidence of being able to leave a job and not having to hold multiple positions, I think is an indicator that labor markets are much more healthy than we had prior to the pandemic. And so while that tightness is certainly a challenge for businesses that are trying to attract, retain, recruit workers to move, I think it is an indication that households, that workers are seeing good prospects ahead of them, and they're able to seek better matches and jobs that fit their needs and their desires a bit more closely.
Yeah, not a question, but more just a point. I'll be interested to know if there's data or research around, the influence of the number of people who are starting new businesses and how that may or may not be contributing to the lack of talent people are able to pull in. I don't know that there's a direct correlation, Nick, there, but I do know that the data suggests that there's been a lot of new businesses started. So I do wonder if a lot of people are just reluctant in that respect to go back to work because they're trying to build their own business. Okay, let's talk inflation. It seems like the cost of everything keeps going up. Help us understand what's going on and why.
Yeah, we're certainly seeing price growth or inflation that's higher than we've experienced in recent history. It's certainly higher than the Federal Reserve's target of 2%. And I think initially, early on, when I was looking at the measures of price growth and the experience that households were having when they had to buy their goods and services, that there was a lot of uneven price growth that was driven by those temporary factors associated with the pandemic. And so you saw price growth in things like cars and computers and goods, things that people were trying to buy a lot more of when they were staying at home. But you're right that as we've moved through some of the initial parts of the recovery and are now moving towards an economy that's more open, you're seeing much broader price growth and some indications that it's a bit more persistent. Housing price growth, for example, has started to pick up where it was subdued during the early parts of the pandemic. And some of the prices of services, again, that were very subdued early on. So, going out to restaurants and going to hotels and leisure travel, which folks weren't doing a lot of, now that they are, you're seeing that type of price growth. So it is much more broad and showing up to be a bit more persistent this year. Now, I expect that some of that inflation pressure will continue, particularly through the first half of this year. Healthy household balance sheets, healthy wage growth is going to be a contributor to some of that. But I also expect that starting in the second half of the year, you're going to see some of that inflation begin to moderate. Now, another thing that you might have been seeing or hearing about is some policy responses to that, where the Federal Reserve, the Open Market Committee, has started to take on a perspective that this price growth is more broad and more widespread and more persistent than originally thought. And you started to see some adjustments to the policy to try to counteract that in recent months.
All right, 2022 is here, Nick, and as we know, it's going to move fast. It just seems like as you get older, everything goes faster. As it relates to Colorado and the region, what are the key data, the economic factors that you'll be monitoring, and how can everyday Coloradans keep tabs on it if they want to?
Ryan, I think that's important to what do we look around to see to give us an indication of how healthy that recovery is, how healthy that growth is going to look. And I think, unfortunately, we're having to first look at the number of COVID cases and the rise in the potential rise in hospitalizations that you would see. So we're still in a position of wanting to monitor the pandemic itself. But fortunately, we're starting to see some broader indications that many vaccinated folks and others are still able to move around and are not getting as severe cases. You're not seeing the hospitalizations pick up. You're not seeing the type of pullback in economic activity with this wave that we had previously, but it's still something to continue to monitor, especially how quickly we're seeing the latest wave spread throughout the region. And frankly, one of the things that I continue to monitor is just mobility of people around, that willingness to travel, that willingness to go out to restaurants, the willingness to move from their homes into other parts of the economy. Because to me, that's a good indication of what is the reopening look like. How close are we going to be to the normal economic drivers of the health that we want to see and for households and for workers? It's how willing are they able to move around and switch jobs and go out to resorts or restaurants or be able to take jobs that are further away from their home. And so that mobility is actually a pretty good indicator of the health of the recovery and economic growth going forward.
Gotcha. I heard mobility, COVID hospitalizations. I heard how our restaurants are doing might be a good indicator as well, Nick. Nick Slide with the Denver branch of the Federal Reserve Bank of Kansas City. Thanks for joining us.
Ryan, always a pleasure.